Jay was so excited to call you, Anna. Like AJ, right at the last moment, was like, "Oh, I screwed up this the timing of this event. I don't know if I'm going to be able to make it." And Jay immediately texts me. He's like, "Hey, should I call Anna to fill in?" And I was like, I took a couple minutes to respond. I was like, "Oh, well, let's see. Maybe AJ could do a different time. Maybe he could work it out." And he's like, "Anna's in."
Well, I hope you're not too disappointed. I'm glad to be back with you too, Kyle.
No, I was just making fun of Jay for how excited he was.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 59 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and we had to mix it up a little bit here. We had AJ was in Brazil. He was supposed to come join us, and apparently it's some Porsche event. He just showed up at the last minute. He was like, "That's much cooler than you guys," which I respect. It is cooler than us, but still, I can be bitter about it.
I think he went to a strip club and met a girl named Portia.
Oh, is that what? But it actually worked out for the better because we have as Jay calls it, emergency economic update this week where we're just talking economy. And so we went and got the smartest person in the room, Miss Anna Kelly's the second time she's been on our podcast, the only double guest. So welcome, Anna.
I feel honored. I used to be the only woman in the room. I'm a co-author with your wife in the amazing book for anyone that doesn't have it. Shameless plug, but I'm thankful to be back here with you guys, being the smartest and only woman in the room.
I'll give you that free plug.
Wait. We leave the plug until the end. We don't plug.
No, that's a good free one. We'll leave that one in. Did you show up with a drink this time, though, is the question.
I showed up because I'm tired and I've been sick with a cup of coffee. Dunkin'. America runs on Dunkin'. Anna runs on Dunkin'.
If you're gonna drink coffee, at least you pick the right one.
Well, and at least Jay usually shows up with the Kirkland brand Irish cream to pour it in there. Is that what you got going on, Jay?
No, today. So we had a little party this weekend, and my wife sent me out to buy some alcohol, and we have some alcohol left over, so I'm being forced to drink it tonight. So we have our 1.75 liter bottle.
Oh my God, that's awful.
Of Kirkland vodka. Like, it's going to take me 2 years to get through this. So I'm drinking the Kirkland vodka with the LaCroix orange sparkling water in my Drunk Real Estate mug.
I remember my first high school party. It was awesome. Mauricio, how's it going over there, man?
It's going good. Jay, are you going to give away one of those mugs at the end of the show?
Yeah. So I tell me what what's going to be a prize for. How do we decide?
We'll leave that till the end, but I just wanted to tease everybody that we're going to be giving away a little swag. Is that what it is? Is it swag?
Yeah. So I've got an hour to figure out like who we're going to give this to. But yeah, we'll give away a mug at the end of the show.
Cool. I am pumped because I missed Anna last time. This is the second time she's here. I think you were replacing me last time, so I didn't get the pleasure of doing an episode with you. So I'm super excited to have you on today. Thank you so much, not only for coming on, but for coming on last minute. Like, we literally found this out like 5 minutes ago or whatever, because that's how AJ rolls. And so anyway, excited to be on the episode with you, Anna. And I decided to spice it up a little bit, literally. Mix it up a little bit. One of my wives. My wife's one of my
Dave, you got to cut that out.
Nah, leave it in.
I have a wife, and one of her favorite wines is Rambauer, which I think is a lot of people love Rambauer, but I've never had the Rambauer Zinfandel. I don't even drink Zin, but I saw it today. I'm like, you know what? I'm going to try the Zin. It's usually spicy. I don't drink almost ever Zin, and let me tell you, it is delish.
They sell that at my Costco.
I don't think you could say I'm going to try the Zin. Like, that's the kids have kind of adopted that for other substances.
Dude, I'm at the age, Kyle. I'm a middle-aged man now, and I don't give a rat's ass what other people think. So I'm enjoying it.
Mauricio, hold up your glass real quick. That's not a Zin. Zin. I'm sorry. For some reason, you said Zin, and I heard Chardonnay, and I'm expecting a white wine there. I was so confused.
Are you okay, man? Over there?
No.
Jay's drunk. Well, that vodka's getting to
That
Jay pretty
Kirkland
quick here.
vodka. It's just got you.
He said Vin, and for some reason in my mind, because they sell that Rumbauer, but in a Chard.
That's right. That's my wife's favorite wine is a Rambauer Chard. So we drink that stuff like water at the house. And so when I saw the Zin, I even showed it to you. It's a red. See the red. Anyway, so it's Zinfandel Rambauer, and it's very nice. It's very delicious.
I'm so used to seeing the Chardonnay that I just did when you said Rambauer, I assumed Chard. Sorry.
Well, it's going to be a fun episode. Dre's already drunk.
I'm already drunk.
So I'm still in Canada. This is my last week in Canada. And so my dad listened to our episode last week, and he was embarrassed when I mentioned that he didn't have any Canadian beers. So he came home today, and it was hilarious. He came home with a bag full of just single beers and like 12 different options for Canadian beers. And he just like set it on my lap. He's like, here you go. And so anyway, I had my choice of Canadian beer. So I went back to one of my old faithfuls when I was younger, and I went to Alexander Keith's, Pride of Nova Scotia. It's great. I love it.
Are you going to drink all 12 of them?
No, I hope not. Jeez, are we going to have that long of an episode? We got a lot to talk about, but I don't think we're. So that's a good segue. Let's get right into it. Jay calls this an emergency economic update, even though usually emergency is like outside of normal time, and we're doing this at the exact same time we always do it. And it's lucky we kind of did it, because if we'd done this on Monday, we were freaking out a little bit. Group chat was going crazy. We didn't know what was going on. Everything was tanking. And luckily today, things leveled off a little bit. Cooler heads hopefully prevail. But before that, we had the 10-year treasury go down. I think it sits at like 3.9 now. S&P's under 5,300. Historic 2-day drops. So on today's episode, as a special thing, we're going to answer questions that some people have posed to, I think, Jay. No one asked me any questions. And so we're going to answer what's happened, what's happening, what's next. So Jay, can you kind of give us an update on what's transpired since the last episode?
By the way, before you get going, usually for Jay, an emergency is when like Costco isn't open when he goes over there. That's for him is like a major emergency. But this is not an emergency, Jay. This is just a regular episode, just like when Costco's open during regular hours, buddy.
Yeah, this isn't a level 1 emergency. This is a level 2 emergency. Nothing to do with Costco. So yeah, we did an economic update, a short one last week, and basically we didn't have much to talk about. It was status quo. We saw the inflation number had come in, the PCE number, which was pretty uneventful. We saw retail sales. We saw a few other things. Basically, everything was just kind of treading water as it's been doing for the last several months. And so I think we may have mentioned that the July employment numbers were coming out on last Friday, but we didn't really talk much about it or think much about it. But it turns out that there was a big risk leading into those employment numbers. And this goes back to a discussion we had a few months ago. And as far as I know, like nobody was talking about this a few months ago. And now after Friday, everybody's talking about it. And that's this thing called the SOM rule. And the SOM rule is this rule named after an economist, Claudia Somm, where she hypothesized, and the data bears it out, that one of the single best indicators of a recession is when the unemployment rate goes a half point above the lowest point it's been, the 3-month lowest trailing average of the past 12 months. So basically, if you look back 12 months, you take the lowest unemployment rate for 3 months during those 12 months, and if it goes a half point higher than that in the same year, that is the single best indicator of a recession. Basically, it's the unemployment rate is spiking up relatively quickly, and that's an indication of a recession. And on Friday, when we saw the unemployment rate at 4.3%, that was a good 0.55, so 55 basis points above the lowest point that we had seen in the last 12 months. So it triggered the SOM rule. And
I'd like to point out too, though, like, first of all, the SOM rule, like, she's very much alive, very much vocal. You could find her very easily talking about this. And she's come out herself. Like, this is not a rule. Like, this is just kind of me looking back. I noticed this correlation. I thought it was, it's like 100% correlation. So I thought it was like something we should talk about, but it's not a rule. Like, she's been all over the place saying this. And yet people still are like holding it as gospel right now.
Absolutely. She's come out and she said that this time could be different. All the money printing by the Fed and the weirdness on the yield curve could make this time be different. But it's had a pretty good history. It's predicted or preceded every recession since the 1970s. So the last 8 recessions, there's only been 2 false positives since the 1950s. So it's a pretty good rule. And so it was enough that when the unemployment data came out on Friday and people started talking about the SOM rule and it started getting press and it kind of had a snowball effect. And everybody started freaking out and the markets just sold off on Friday. Investors getting super scared. So they were taking money out of the stock market, putting it in bonds. So the stock market was dropping, bond yields were dropping.
So do you think it was just the SOM rule, or do you think it was the 114 on the payrolls?
So both. I mean, obviously, it was together. So the SOM rule was basically unemployment rate had gone high, but the other piece of the data was that we saw very few jobs created in July relative to previous months. Now, 114,000, it's a low number, but it's not so scary in and of itself that I think it should have triggered the sell-off that it did. So I think it's a combination, but I think it was that unemployment ticking up to 4.3%, in my opinion, that was the big catalyst.
Yeah, because it doesn't make sense. Like we've already talked about this with these revisions, right? But like if you go back even just April, like after the revisions, we were at 108. And like you don't have to go back that far to then we were at 105 back in October. So like it's not like one low print should make everyone freak out. It's just like I don't know if it was a combination of I thought it was more along the lines that Powell put everyone on edge, where he was like, "Oh yeah, we talked about cutting this meeting and we decided against it," basically implying that he thinks not everything's okay, and then just right in succession, right after, there was an indicator that not everything's okay.
But Kyle, I think if you go back, I'm sorry, last time I was on the show, we talked a little bit about the McKelvey rule being triggered. And so that was basically the same rule, but basically looking back, and it's also almost 100% accurate, very similar to the yield curve, where when the rolling average is an uptick in 0.3% over time, that's usually where the recessions are backdated to. And so I was seeing a lot of articles talking about, the McKelvey rule's been triggered, but it's okay because unemployment's not at 4 yet. If we go over 4 and the SOM rule is triggered, which is 0.5, then that's when we really have to start, Powell's going to have to start looking at it. So there were quite a few economists talking back, May, June, or early July that we're getting close to the SOM rule, but we're okay until then. So I think when they've already been kind of primed that this SOM rule is something to look at least for a month or two, and we got the big negative revision, which has made some rounds and economists talking about it, to the last quarter of 2023, showing instead of creating 600 and something thousand jobs, we actually had a loss of 192,000 full-time jobs. So we haven't seen the revisions yet. And I think when those revisions come, and there's been this talk about we're fine until we hit over 4, and Powell has said we're not worried until we get closer to 4, so now it's gone up higher than they thought. But when he comes out the day before and says, employment's fine, everything's fine, and then all of a sudden they see this rule triggered saying, it's not so much, then I think the question is Powell lying to us? Things are worse than he says. Maybe the recession really is here, even though he says the economy's healthy. So I think it's just been months and months and months of this denial.
Maybe they're telling the truth that they don't have access to this data before we do. They only get it the day before, and you're like, or the morning. Like we're like, okay, come on. How do you not have access to that?
100%. Because I track the conference board. So I've been tracking the actual data really, really careful at the Dallas Fed, the Chicago Fed, the conference board. And every single day you can go on and it's got an update to where we are on the SOM rule, on the McKelvey rule. They show state by state data. So back in May, there were already 35% of states that had triggered the SOM rule that based on their own unemployment numbers were in recessionary conditions. Below national GDP triggered the McKelvey rule. So the conference board, they're watching the data very, very carefully. They mention it in their their beige books, I'm sorry. So for them to pretend that, for people to worry that Powell got caught off guard because the data came out 2 days later, I call bull on that. They know the data, but they don't want you to believe that the economy is weakening.
And you look at all these differences. You mentioned the Somme rule, you mentioned the McKelvey rule, the McKelvey, all these being triggered. Don't forget the curve also, the inverted curve triggered as well. So usually what happens, and there's been a lot of talk about this too in everywhere really, is we have the curves uninverted. They uninverted a long time ago, as you guys know, the 2 and 10s and the 2 and 30s and all these curves uninverted. Interesting left, the 2 and 30 uninverted, I think a few weeks ago, if not a few months ago. And now the 2 and 10 briefly uninverted. I think if it wasn't
Monday.
yesterday, it was on Friday, just briefly uninverted. Now it's back inverted again. But that's also another trigger that most people say, look, the uninversion of a curve is one thing, and that's usually predates a recession. But the actual recession typically happens when those curves uninvert, especially when it's the shorter end of the curve that's actually the one that's doing the uninversion. So in this case, what's happening is the short end of the curve is going down at a faster rate than the long end of the curve. And that's primarily because of the expectation of the Fed cuts and the expectation that things may be not going as well as people think. And therefore, the Fed's going to have to step in and cut some rates. And that's pushing the short end of the curve lower, which is now pretty much flat now. I think it's back to being inverted, but it's basically hovering around zero now. It's here it is. It's 3.9 versus 3.98. Like it's literally
The other thing,
almost
Mauricio,
flat.
is big money. Big money knows the history of recessions, and the big money knows that they kind of follow a pattern. It's usually housing leads the recession as a leading indicator, and then there's a framework called the Hope Framework by Michael Kantarowicz, and he talks about how housing goes in recession first, then manufacturing orders start to decline, manufacturing goes into recession, then you have a profits earning miss and profits recession. And unemployment's the last leg to fall. So it's a pretty lagging indicator. So if the markets are saying, wow, now we do have a higher unemployment, miss, we have Intel laying off jobs, we have lots and lots and lots of corporate bankruptcies, small business bankruptcies, store closures, and now they're seeing unemployment finally, hit that pretty confident rule in addition to the ones that have been triggered before. I think it's screaming to the markets like this is the lagging indicator that is here. So even though the coincident indicators in real time don't say we're in a recession, they know that unemployment typically doesn't really rise rapidly until after the Fed cuts rates. So
thank you. I have been beating that drum for a year, where the Fed has been saying, "Oh, we're being data dependent. We're going to look at the data," and then I kept saying, the Fed, you don't see the actual movement in the jobs data until after the Fed has already started cutting. So how can you be data dependent that way? I'd like to pull Mauricio here and pat myself on the back, because Mauricio likes to do that sometimes whenever he makes a correct prediction. And then I wish, if we had the money and we had someone pulling clips and doing all this stuff, we would do it. And we go back to a few previous episodes where I was like, you guys were talking about, oh, there's not going to be a rate cut, yada, yada. And I said, just wait. We're already at 4.1. The Fed had predicted we were going to have 3 rate cuts to get to 4.0 unemployment by December. We're already at 4.1. Just wait. The moment we hit 4.3, everyone's going to freak out. It's all of a sudden that's almost 4.5 and everyone's going to lose their minds and we're going to have, and they're going to cut. And what just happened, boys and girls? 4.3, everyone freaked out. So I'd like to say, of all my predictions, don't go to the predictions episode and check that one out. Go to the other episode where I actually got this right and check that.
What do you guys think of that? Because what you mentioned touches a little bit on this narrative that I'm hearing, just kind of, again, watching a lot of stuff over the weekend. But there seems to be a narrative, and maybe this is part of it too, where lately, especially with the Fed, right? Like if Fed cuts, it's almost like bad news is good news and good news is bad news. It's always like that reverse thing. So, hey, the things are going bad, so the Fed's going to cut, which is good news. And so, but it sounds like the narrative had changed a little bit in the sense that instead of being like bad news is good news, now like bad news is, oh crap, bad news is bad news. And I'm just curious if you guys think that's part of what's going on as well. Like the sentiment is starting to turn.
Yeah, that's exactly what happened. Normally soft jobs data would be like, everyone's like, that's awesome, we're going to get rate cuts and the economy's saved. But now, as I said, I think it was just that a couple successions of the Fed speech saying like, oh, everything might not be okay, but jobs are fine. And then all of a sudden jobs aren't fine. And everyone's like, wait, so even if we get a cut, everything's not going to be okay. We might actually have a recession, soft landing canceled. And it was a little freak out there. But as I said at the beginning, though, it seemed we're Tuesday when we're recording this. It seemed like everyone kind of stopped freaking out a little bit, but we'll see how the rest of the week goes.
So just to cover all our bases and play devil's advocate on this, I think a lot of us are assuming that because we saw a lot of money move out of equities, out of the stock market, it's kind of an indication to a lot of people that, oh no, here's the trigger to the recession. Here, this is the big one. This is the start of it. But one thing to consider is that the stock market is objectively overvalued. And has been for a really long time. I mean, there's another rule. If we want to talk about all these rules named after people, there's something called the Buffett rule, named after Warren Buffett. Warren Buffett basically noted about 20 or 30 years ago that the average price or the average market cap of equities of the stock market should be about the same as GDP. So if you divide the market cap of all the stock market by GDP, historical average is about 0.9 ratio. We're at almost a 2 ratio, 200%. So the value of stocks is about twice that of GDP. If we were going to look at historical averages, the value of equities of the stock market right now should be about half of what it is. And if it was half of what it is, it would be appropriately valued. So in theory, we could see tremendous sell-off of the stock market from here. And it doesn't necessarily mean that we're at the beginning of a recession. It certainly might, but it could just mean that we're seeing a reversion to the mean. We're just seeing a normal correction back to those historical numbers. And so I just want to point out that a lot of people are freaking out, and there's a good bit more fear right now than there has been over the past however long. But it's very possible that this fear is unfounded, and what we're seeing is not necessarily the beginning of some catastrophic event.
I would say, so speaking of Buffett, so real quick, speaking of Buffett, I thought you were going to talk about the fact that Buffett also increased his cash piling to a record $277 billion after selling, I think, half of his Apple stock. So he clearly thinks the market's overvalued, it's not up there, and he's shoring up on cash to do what he usually does, which is when things go down the toilet, he jumps in with his cash and starts buying up stuff when things are valuable.
And I hate how often people say this time is different, but I feel like that rule was kind of before, like now it's just become commonplace for companies to fuel growth with debt and buy back stocks and do all that stuff. And debt is such a bigger player to the fundamentals of these businesses that it kind of might change a lot of those rules. And so until we see kind of the debt siphon out a little bit more, then I think, these traditional rules might have a tough time keeping up.
Well, I think that's the real issue is there really is. I mean, I was in private banking before I went into real estate. So my corporate life, I was a private banker and I worked at AIG with institutional hedge fund investments for years and years and years. So I know more about, the institutional side stuff before I ever got into, real estate and multifamily. But the fundamentals, I've gotten the stock market wrong the last couple of years because it's so disconnected from the fundamentals of historic investing. Even Warren Buffett will say the same thing. You've got to be principled as an investor, but when you have massive asset bubbles, which we've had over the last, very long expansion period, especially post-COVID with a lot of money coming in, people have money and they're just looking for a place to put it, right? And so people get excited about anything where they think they can create yield. And it's the stereotypical irrational exuberance at the top that, hey, if I just go in the Mag 7, I can't lose, right? They just kept going out. But if you look at the breadth of the S&P, aside from the Mag 7, which is now, Mag 4 or whatever, the breadth of the S&P was really starting to struggle. And I think you've got a lot more investors in this last post-COVID era rushing in that are not educated, institutional, money, big money, smart money like the Warren Buffetts. You've got people making AMC and GameStop go crazy, right? So they're just throwing money at anything. And it's that new panic that I think starts to happen when they start to see the big money players like Buffett come out. They don't know what they're doing. They just don't. And so I've been really nervous about the PE ratios and where they are, but there's a really good book. I don't necessarily love everything she writes, but Nomi Prinz wrote a book. I think it's called Permanent Disconnect. And it is really a primer on how the market is no longer sticking to the fundamentals. And so people are staying in as long as they can until they see it start to correct. And then I think the panic, because they're not really educated on why what's happening is happening, I think could make a market correction much worse maybe than we've seen historically. But the other thing is typically the markets don't crash until after the Fed cuts rates, because everybody thinks you're still in an expansion period till the Fed admits it by cutting rates. Because again, people think the market is the stock market's the leading indicator. It is technically a leading indicator, the S&P 500. But before that, it's what
that's what everyone's banking on right now, right?
Right. But really, monetary policy comes first.
Everyone's guessing what the Fed. Yeah, everyone's guessing what the Fed's going to do now, right? So the problem is that we have this meeting. The next meeting is until September, so we have like almost 2 months until the next meeting. And so the problem is that we don't know exactly what they're going to do.
Right. And if they do cut, it's history says a 35% market crash is coming. So I don't think it's crashing because a recession is here. I think it's crashing because they're starting to get closer to Powell saying a recession is here. They're seeing the unemployment number tick up before Fed funds rate are cut, and they know employment's going to get worse. But then you add the yen, you add the threat of Iran going after Israel, you add uncertainty in the election. And I kind of think it's the combination of all four of those things that really caused the freak out that we saw on Monday.
Well, that's a question I'll pose to Mauricio. So since we don't have a Fed meeting until September, and if you look at like now the market predictions for rate cuts, now it's actually a minority that we're just going to see one rate cut. The majority thinks that we're going to see 2 rate cuts. And there's a lot of talk that people think we might even see an intermeeting emergency call where they're going to cut rates as well. Now, keep in mind, we have Jackson Hole as well in the middle there. So Mauricio, do you think we're going to see some sort of emergency meeting to call rate cuts, or they're just going to ride this one out and do the 1 or 2 cuts when they have the next one?
Is it like when you say emergency, like Costco shutting down emergency, or just a regular emergency?
No, like I would say this is a level 1.5, not a level 1.
Obviously, I'm not Nostradamus. I mean, I will say that they don't usually do emergency cuts until something happens that's pretty, I'll say, catastrophic and unorderly, right? So I remember very clearly back in even just 2000s, right? I remember for a whole week, I remember this very specifically, like the stock market was just getting crushed. It was down 1,000 points, then it was down another 1,000 points, then it would rebound for 300, then it was down another 2,000. I mean, it was losing. I was trying to pull the data. I didn't have time, but it was just getting absolutely crushed. It was very disorderly. That was the thing. It was very disorderly coming down. So I think that's what it's going to depend on. I mean, the stock market went down quite a bit on Monday. That was pretty bad. Today it's kind of rebounded, and it really is going to depend, I think, on what the rest of the week and next week looks like. If the rest of the week, even if it starts going down significantly, as long as it's somewhat orderly, it goes down 1,000, goes up 400, it stabilizes, that's one thing. But when it starts, like when panic starts happening and people like really dumping stocks because they're freaking out and they're jumping into treasuries because they think something's going on, that's when the Fed might consider it. But at this point, to speculate on it, this is going to sound terrible, but it is really data dependent right now, whether there's going to be an emergency cut, because it just depends on how disorderly things happen. I don't think the Fed is necessarily upset that asset prices are coming down. They kind of wanted that, right? They just want it to be done in an orderly fashion. They don't want it to lose. Look, I know we're probably going to talk about Japan in a second here, but like Japanese bank stocks lost 25% of their value over the last 2 days. Japan stock market went down 12% in 1 day. That is a unorderly, catastrophic. We're like down 3% 1 month, and 2. Gold is down $40, whatever. It's not totally disorderly, but if that continues to happen over the rest of this week, that we're recording this on Tuesday. Tuesday was a pretty nice little bounce. Let's see what happens Wednesday, Thursday, Friday, what's going on next week. And if it's orderly, I say no. If it gets out of control and it's disorderly and people are panicking, then yes, I think it's in the cards.
I don't know why my gold went down after all this, but don't worry, Jay, I'm going to throw this at you because we had this discussion yesterday and you were pretty convinced emergency cut was happening. Now that you've seen today where things kind of leveled off a little bit, have you changed your tune?
I'm not gonna lie. I got a little bit caught up in the fear and the hype myself. I actually
put some money on it too, Jay. I don't know if you're getting that money back.
I did. I have $100 wager with Scott Trench, the CEO of BiggerPockets. I said there's going to be an emergency rate cut before September. He says there's not. I like his side of the bet right now. I think it's not likely that we're going to have a rate cut, but I still think it's very possible. And here's the big thing to remember. The Fed, I don't believe, cares about the stock market. I don't think the market dropping, the Dow dropping 1,000 points or the S&P dropping a few hundred points or whatever is going to be enough for the Fed to take significant action because that is not their concern. I think they're concerned about the more fundamental economic issues. They're more concerned about bank failures. They're more concerned about housing. They're more concerned about like people being able to meet their daily needs. And so I don't think just the stock market continuing to drop is going to trigger an emergency rate cut. But if we continue to get soft economic data that indicates that waiting till September could put the average American in more peril than they're currently in, I think that's what could trigger that rate cut. So as of today, I'm not particularly concerned about a rate cut, but I think given that we have 2 months and there's a lot of data that's going to be released between now and then, I could see enough negative data coming out that the Fed feels like they have to stave off like a major downturn.
I think Powell tonight is having the best sleep he's had in the last year, because I think he was so scared about cutting rates and it having the opposite effect of this, right? Where he was going to go and he was going to cut rates and everyone was going to put on their party hats and everything was going to the moon. And he was waiting to try and change the rhetoric and waiting for something. And I predicted that he was going to have to wait for some sort of like little bit of bad news to preface it to say, I'm going to cut rates so that people wouldn't party in the streets. And it happened within 2 days of each other, where he implied that he was cutting rates and he had bad news at the same time. And so now he doesn't have to worry anymore about everyone just going nuts and the stock market going up 10% and, all these, the inflation just going crazy. Now he can actually cut rates and people aren't going to just spend and do stupid stuff. So I think he's pretty happy about that. I'm pretty happy about it, to be honest. I was scared about that as well.
Yeah, I kind of thought Jay and I bannered a little bit about this on Facebook, that they could potentially do a preemptive, cut when I saw what was happening on Monday. But the more I think about it, he's been pretty principled about saying from the very beginning, we need to end, he didn't use these words, but those that are in his circle and know and that have been on the Fed, they want to end the Fed put and the perception that they're going to rescue the markets instead of rescue the little guy and the basic economy. And he's been pretty vocal about being concerned about the unregulated shadow banking system. And, most of the loans that have been done that are going bad are not bank loans, actually, even though there could be some risk of some banking fallout. They've done a lot of kind of backstop that with the bank term funding program and lowering reserve requirements. But it's the shadow banking system that has all of these bridge loans, private equity loans, for example, that are falling out, that they want to be able to fall out. And I think they're holding rates as long as they can to both break the Fed put, to be able to let the fallout be as bad as it can without breaking the banks and totally breaking the consumer. And then also being able to say, we broke inflation, we didn't go too early and become an Arthur Burns, but he's got this legacy of the Fed has been fickle and they continue to, basically cater to every tantrum meltdown of the stock market. And then they have to go back to the zero bound. And he has said he wants to break the zero bound. And when I've read Fed minutes and I've looked at the conference board and I've looked at the projections that they all have and the actual writing of their slides, they show that they're going to have unemployment go up to probably about 5%. And they show that they expect rates to not go lower than about 2.8%, even when they start to cut rates. So I think if Powell did freak out and say, okay, we're going to do an emergency rate cut, it would just spook the markets even more. They would have even more of a very rapid decline, like the 35% that we've seen historically. And that would force them to have to cut so deeply, so quickly. He'd lose his legacy of trying to break the Fed put and not going back to the zero bound. So I don't think he'll do it. I think to your point, Kyle, he's sleeping pretty well going, okay, the market, we're letting some of the slush, come off. The markets keep thinking every time we say something bad, they think it's good, and it keeps going up, and he doesn't want to see those asset values continue to climb. And so I think that he's sleeping well, like you said. And the more I think about it, the more I think they wait, unless, like Mauricio said, they have a real crisis on their hands. And that would either have to be a bank crisis, more banks fail, or probably more a bond market and credit crisis, because the bond market is so much bigger than the stock market is. So if the bond market starts to react and they have a bunch of failed bond sales, which we did see a little bit of, I think it was Friday or Monday, I think a bond market freeze up and the credit market's freezing up, that would be like a self-perpetuating doom loop that would really push us into a recession really deeply and exacerbate layoffs. I think that could make him cut, but barring that, or the data being really bad this week and a whole lot of layoffs and a really, really deep correction and Iran going after Israel, I think he's going to hold till September and try to save face.
So here's the interesting question, because we've talked about this on the podcast before, and it just occurred to me, and I want to bring it forward because when we have more money, we'll clip this in a few months and we can go back to this clip. It's going to be awesome. So everyone's assuming that the Fed has the ability, if it wants to come in and quote unquote save the market, do the putt, right? We've talked about this before, where if you remember back in 2020, when the whole thing was unraveling, the Fed came in to rescue the market. They reduced rates to zero. That didn't stop the bleeding. They then came out with this bank terming the funding for the banks that we all know that just expired last March. That stabilized it for a couple seconds, but then it came back down. It wasn't until Congress acted with the CARES Act and pumped God knows how many trillions of dollars into the system because the CARES Act, that's what finally calmed the markets. It wasn't the Fed and their action. So I'm just curious to find out if we do have a similar scenario. Nobody's saying we are. So that was obviously 2020. That was a pretty...
And that was pretty unprecedented, right? Like, I think it was fear of unknown. Like,
100%. But
we know what a recession looks like.
I'm just curious, if the market starts tanking, people are freaking out, the Fed steps in and reduces, hey, we're going to 50 basis point. Oh, that's not good enough. 75, that's not good enough. Let's get it down to zero again. And is it going to work, or has the Fed kind of lost some of its ability? They think they can fix it, they can't. I'm just curious about that. Just kind of a thought experiment because we have talked about it on the podcast before about what happened last time, and I'm just curious if it's going to happen again. Does the Fed really have the bullets in the gun, to use a terrible analogy, but does it have the bullets or not?
Well, because they're hoping that they're just able to, little rate cuts, little here, little there, and we can kind of just smooth this out, and we can maybe get a mini recession, maybe not a little bit. And I feel like a lot of, like, we're obviously in the real estate community, and a lot of people are kind of holding to that, and they're saying, hey, like, we just need these rate cuts and everything's going to be fine, and not looking at the other side of where, Mauricio, obviously you said before, like, oh, why are these rate cuts happening? Like, is this happening because we're in a recession? Recessions are bad for real estate investors. But
I mean, Kyle, how easy was it for you to get a loan back in 2008, 2009, when interest rates were at zero? Yeah, interest rates went down to zero, but good luck getting a loan, right? Because you had, it was very difficult.
I will plug our industry, because the good thing about being in the apartment industry is there's always loans. There's always, Fannie and Freddie will always backstop. Like, we literally bought a property in the height of COVID. Like, we were locked down. We couldn't even do proper inspections because of the COVID lockdown on this property, and Freddie still loaned to us. So Fannie and Freddie still backstop that. If you want to talk about the rest of the commercial market, none of those banks were doing anything.
Or if you wanted to buy a home, like, oh, wait till wait till mortgage rates go down to whatever. And it's like, oh, the real estate market's going to blossom because everybody's going to be able to get an interest rate, mortgage rate at 3%. It's like, yeah, good luck. It's at 3%, but you got to have, $10 million in income to qualify.
Well, I guess that's the question right now then too. So we just saw the 10-year treasury go down to 3.9. Obviously 10-year treasury is a big indicator of mortgage rates. So is this really going to significantly impact mortgage rates? I guess is the question. Are we going to see significantly lower mortgage rates over the next couple months? Or are we still kind of waiting for the Fed to actually lower these rates for us to see that?
I think it kind of comes back to, Mauricio, what you were alluding to in terms of how much control does the Fed really have over interest rates and over the economy. And I mean, obviously, monetary policy has significant impact on the economy. We can see that with what higher rates have done to commercial real estate and to the banks that were relying on cheap money for so long. But I do think when it comes to long-term mortgage rates, we really have to look at an era of fiscal dominance, when Treasury markets are more concerned right now about the federal debt that the United States has than they are necessarily, whether we're in a recession. I mean, an average recession lasts 10 months and you're out of it. And a lot of times it's almost over by the time it's declared officially. And then you've got about a 2 to 3 year recovery period. So if the markets don't think this is a terrible recession, that it's not going to be long and deep, then I think they're looking more at, what's the long term. And again, if you're dealing with like bridge loans, or you're flipping houses, or you're flipping apartment buildings, you're going with the overnight Fed funds rate. So yes, the Fed funds rate is going to impact, what your rate is, and how deep the recession is going to impact how much the credit markets dry up. If it's a mild recession, credit markets for, multifamily may be just fine. And then we've got lower rates. But what worries me this time is we've already seen that really tight pullback in the credit markets before we've had a recession. And historically, even though we haven't had many recessions that look just like this, historically, banks really tighten only after a recession is declared. They started about 6 months in, and they go, wait a second, how bad is this going to be? And that's when, you can't just go get a loan just because rates are low. But that's the short-term loans that, SOFR really impacts. I think the longer-term treasuries that we typically use, especially for 30-year mortgages and even some 10-year Fannie Freddie stuff, they're looking at the treasury market. And depending on how the government reacts with fiscal policy to this recession, and how much debt we go in, and how much QE comes back from the fiscal side, right? The helicopter money dropped by Congress, that increase of the debt could cause us to have failed treasury auctions. And again, that could cause treasury rates to go higher, even while the overnight rate, the Fed's funds rate, is lower, because it's set by the markets that are saying, wait a second, if there's more risk of US government debt and long-term inflation coming back because of deglobalization and debt, then they might keep the treasury markets rates might be higher. And that could actually mean mortgage rates don't come down nearly as much as what people think. So it's really hard to say. They're not exactly correlated, but it all, there's a lot more of the geopolitical risk and what the next 10 years looks like that comes into play for the long-term rates and what the credit markets do, in my opinion.
And here's the other thing. I mean, you're giving the potential downside scenario where mortgage rates don't come down a lot because of other things going on in the economy. But here's what I think people are going to be upset to hear, that even if you go back and you just look at historical averages, and I know I always talk about historical averages, but I'm a big believer that history is the best predictor of the future. If you look at historical averages, historically speaking, the 10-year treasury is typically between 1.5 and 2% above the federal funds rate. Yeah. Not always. Sometimes it goes higher. Sometimes it even goes negative, as we've seen. But historically, 1.5 to 2% above the federal funds rate. And then mortgage rates, 30-year fixed mortgage rates, are historically about 1.5 to 2% above the 10-year treasury.
Yeah.
So historically speaking, mortgage rates are going to be somewhere between 3 and 4% above the federal funds rate. Where do we realistically think that the Fed is going to drop the federal funds rate during this cycle? I think unless we see some major negative economic shift, I don't think we're going to see the federal funds rate below 2.5%, let's say.
That's exactly where they are predicting they will end if it's a recession. Yeah.
Yep. And then you add on top of that the 3 to 4% historical delta between the federal funds rate and mortgage rates, and 30-year fixed is somewhere between 5.5% and 6.5%.
Right.
So for anybody out there that thinks that we're going to get back to 3.75, 4.25% 30-year fixed rates, I think it's unlikely based on historical averages.
Unless the recession is worse than what the government is predicting. And then you got to be careful what you wish for, because if the recession is worse, then you're also going to have a higher risk premium. So that 1.5 to 2% above the treasury is assuming traditional risk. But if lenders say, wait, we think there's a whole lot more risk that, inflation comes back and we have war, those are like the worst things, right? Then that's going to be an even higher rate from there. And the credit markets will definitely pull back, and it'll be much, much harder to get loans, not only government loans, but also and especially private market loans.
Yeah, and don't forget, like, to your historical point, Jay, I mean, things have changed a lot since 2008. I mean, 2008, we went to like the ZIRP policy, the zero interest rate policy that was never done before. You would maybe bring it down, but to go to zero and keep it at zero around the world, you had you had central banks at negative interest rates. Like that is like a brand new, that's not a historical, you can't go back and look at history and be like, oh, this is when, it's been a negative, whatever. This is a new phenomenon that's really worldwide. And so I have zero doubt that if the economy gets into a bind, that they will bring down interest rates to zero again. Like, I don't think that's out of the question. If the situation warrants it. In the old days, historically, maybe not. Historically, they'd be like, oh, we can't go down to zero. We'll bring it down. We'll do other things. But now it's like, they'll bring it down to zero in a heartbeat. And so if that, again, not that if they bring it down to zero and interest rates or mortgage rates are at 3.5, 4, that doesn't mean you're going to be able to get a loan. But I don't know. That's just a comment about that in historical. We're in new times since 2008. It's a completely different world out there. Yeah. Central banks are doing things that you would never even have dreamed about back in the early 30s, 40s, 50s, or whenever central banks were created.
And in 2009, China really came into the rescue.
I'm going to push back a little bit on this idea, though, that the treasuries, as far as foreign demand, is any issues whatsoever. Because if anything, that what just happened over the last couple of days, it kind of lends credence to the idea that, like, if the U.S. is having issues, that means other people are having issues, other countries are having issues, or they're scared that whatever's happening in the US is going to lead to issues in their country. And so where are they going to go? They're going to go to the US treasuries. It's just going to happen. And that's why people were like, when they started seeing the flood to treasuries the last couple of days, they were worried about that, like it was going to go down to like 4.35 or something like that. Like that's what the talk was before it kind of leveled off and kind of hit that technical benchmark at 4.0. So like I'll push back on that a little bit. But you're right. Like it's all dependent on what we see the next couple months and
you should I'm going to do a plug for Jay. So Jay, we're all, I think, going to be, except for Anna, I don't think we're going to be at Limitless at the end of the month. And Jay's going to be moderating a panel, and Jeff Snyder, the one and only Jeff Snyder, is going to be on that panel. He's been arguing for the longest time that we have a global dollar shortage. Like there's more demand for dollars that are actually circling. That's usually what's creating the issues. And so there is this demand. So this idea that treasuries are going to go out and nobody's going to want to buy them. If we get to that point, to your point, Kyle, that means the rest of the world is really in a pickle, because if they don't want dollars, what are they going to want?
Mauricio, you've brought this up a couple times, and we were discussing this before the show. So we were discussing Japan, like what's going on with Japan. So first of all, like the Japan started off like the Nikkei index was the first thing where everyone was like, uh-oh, what are we going to do? And then there's all the discussions about the yen. So you seem pretty tapped into that. Why don't you give us the rundown there?
It's a fascinating story. So there's something called the yen carry trade that you probably, if you've been reading the financial, media, whatever, you've probably seen that happen. And that's a big piece of what happened yesterday. I'm not saying it's the sole reason why stock market went down and everything, but that's a big reason. And if you just got to think about it, the US went down to 0% interest rates, and most of the rest of the world went down to negative. And in fact, as of last week, Japan still had 0.1% interest rates. Like we're at, what are we at? 5.25, I've lost track, 5.25, 5.5, whatever we're at. We've been dollar milkshake theory. We've been raising our interest rates for the last 3 years or whatever, from 0 to 5.25, 5.5. And now we're discussing, we kind of peaked, it looks like. Other countries, including Japan, were at negative, and now they're barely at 0.1. And what's happened last week is that, and so because of that, let me just, before that, so what's going on is because of that, people have been doing this trade where they will go, why wouldn't you? Go borrow, look, if you and I could do this, we'd be doing this all day long. You go to Japan and you borrow money at 0.1%. Probably not, because that's the Fed rate. So maybe you're borrowing money at 1 or 2%. And then you turn around and you go buy something that gives you more than 1 or 2%. Like you go buy, I don't know, US stocks or treasuries or whatever asset, your real estate. You're buying all this stuff and you're getting this beautiful arbitrage, just like real estate investors in the US do when they take money out of their home at 4% and they go buy some other asset, as long as you're getting more than what you're buying.
Or the banks when there's a credit facility funding.
or the banks, right? And so that's what's been happening. And what's been really fascinating.
And Mauricio, let me jump in real quick. For anybody that wants to hear a whole lot more about that, we talked about this thing. It's called the dollar milkshake theory. coined by a guy named Brent Johnson a few years ago about how the U.S. is sucking up all this global liquidity and all this money is flowing to the U.S. So episode 44, we talked about that. Really good episode. And so that's what's been happening.
And so you go borrow money from it doesn't have to be Japan, it can be any country. You borrow money from this country at 0.1%. There's only two risks for you. One is the interest rate goes up because now you're borrowing at whatever you're borrowing at 2% or 3%. And that now goes up to 4, 5, 6%. And remember, people use leverage. So interest rates might be at 1%, but then you're able to lever up and really get that spread even higher. But the only two risks for you are, number one, the interest rates goes up. That kind of screws up your thing. If you're borrowing at 2% and whatever you're investing, and that goes up to 10% and you're investing at 8%, that's problematic. Or the currency goes against you, right? Because remember, you're borrowing in yen or whatever currency. You've got to then you've got to switch it over to dollars, invest in dollars, and then you got to pay it back in yen. But as we've talked about in the pod before, especially when it comes to Japan, I'm gonna share a screen real quick. If can I share a screen here? Share screen. Here we go. Entire screen. Let me share this real quick because we've done this in the pod before. But as you can see, even back in 2020, 2021, the yen was about 103, or let's call it 100, right? Which means I could go back and borrow. Let's say I had $1 million. I can go borrow 100 million yen, and I would get $1 million loan, basically, right? So I go take $1 million and I go invest in whatever I need to invest it, and then I've got to not only get my spread, right? I borrowed at 1%, I invested in 5%, I made a spread. Then I got to pay back the money in yen. But since then, the yen went from about 103, hovering around 100, all the way up to 160. Right, so it's lost like 50% of its value over the last 4 or 5 years. That's a huge move when you talk about currency. So that means I borrow $1 million in yen, which is $100 million. I go do whatever I'm going to do. Then I got to go pay back. Hey, I got to pay back my loan. I pay back and I've got $1 million, but now I suddenly have $160 million in yen. I only owe him $100 million. So I've got an extra $60 million or 60 million yen. So I've made money on my interest rate arbitrage, plus I've made money on my spread on the yen. But what's happened lately and what happened last week is that because the currency is getting shellacked, I mean, it's literally lost half of its value. Imagine the dollar losing half its value. That the central bank finally raised interest rates, from a whopping 0.1% to 0.25%. Now, I know that doesn't sound like a lot because they go 0.1 to point, but that's over 100% move, right? It's 150% move. So that's problem number one. And what you saw immediately, if you look back at the graph, you'll see that the yen gained a lot of strength. So it actually, I think, appreciated about 20% or so from 160. It's sitting at 144. So now everybody who has that trade, number one, interest rates went up on me, which is problematic because now I'm levered, right? So now, I was borrowing at 4%, and now it's freaking went to 8% or whatever, or 1.5 times. And now I got to pay it back with more expensive yen. Like now yen's gained 20%. So I'm losing. So what's happening now, and then just tie it all together, what's happening is it's forcing the people who did that trade to have to liquidate other assets. So if I borrowed $1 million in yen and I bought NVIDIA or Tesla or whatever stocks, well, crap, I got to pay that back now. I'm losing. I got to sell those things. I got to liquidate my collateral to go pay back that loan because the trade's kind of going against me. Now, interest rates have more than doubled, and the value of the currency my currency is 20% weaker against the yen. So people are unwinding that trade. They've got margin calls, they've got to pay back the money. So they've got to sell their assets, take those dollars, convert them into yen, which I'm getting screwed now because the yen's appreciated, and pay back my loan. And so that's what the yen carry trade is, and the consequences of that are they're selling whatever it is that they initially bought. If you notice the 10-year, for example, the 10-year started dropping, the yield dropped significantly. Jay, you know this better than I do, with the economic news back then. But since the interest rate went up, if you look at the 10-year recently, the yield's gone back up. Why? Because the bonds are losing value because people are selling them. Why are they selling them? A lot of it, not all of it, but a big piece of that is the yen carry trade. They're unwinding that. They're having to sell their bonds because why wouldn't you borrow at 1% in Japan and buy a bond at 4%? It's like free money, right? So as long as interest rates stay at 1% over there and 4% over here, I'm good. As long as the value of my dollar is at least equal or greater to that by the time I unwind it, I'm all good. But that trade's going sideways right now. Now, maybe next week it goes back. But right now it's going the wrong direction. People are starting having to sell their stuff, sell their collateral, pay back their loans in yen. They've got to swap their dollars for yen, which right now they're getting crushed on. So people are losing a crap load of money. That's why everything's down. Stocks are down, bonds are down, gold is down, everything's down.
Yeah, and it's a good reminder that we're in a global economy. And everything is tied together. And we may think that we have the world's reserve currency. We have the strongest currency on the planet. And we do. But that doesn't mean that moves in other people's currencies and decisions that other countries and investors in other countries are making isn't going to impact hard assets in this country, isn't going to impact our debt, our bonds, isn't going to impact our dollar. It's all intertwined. And a lot of times there's going to be unintended consequences. And this is one of those unintended consequences. Again, literally 3 months ago, we were talking about the dollar milkshake theory, which basically predicts liquidity flowing to the US, the dollar getting stronger and stronger until every other currency is basically bankrupt. And I think there's still a good argument for how over the next 5, 10, 20 years, that's likely to happen. But that doesn't mean it's going to be a linear event. It doesn't mean that we're never going to see the opposite happen and that we're not going to take hits ourselves. And if those hits are timed poorly, as this one was, basically us seeing a hit to hard assets in this country due to unemployment data coinciding with this trade carry unwind in Japan, basically it just exacerbated the negative economic event here.
And this is the issue that the rest of the world has, Jay, right? We talked about, and this is the dollar milkshake theory carrying out, is that countries around the world don't have the luxury that the US does. So Japan's in a really crappy situation because on the one hand, they want to raise interest rates because they can't, it's crushing look at the currency. It's lost 50%. And if you talk to Brent, he thinks it's going to go to 200 to 300. Like it's going to lose another 60%, 80%. But if they try and raise interest rates to defend the currency, which is what they should be doing, if they raise interest rates, more money will go to Japan. It will strengthen their currency. It's going to kill the banks. It's going to kill their bonds because it's just like with Silicon Valley Bank. Now you're holding debt. Your interest rates are going up, which means the value of your bonds are going down. So they're in a tough position.
Mauricio, just real quick, I lived through that. So I was actually playing hockey in Russia when Russia decided to do that whole annexing of Crimea. And I got really screwed on that because I was getting paid in Russian rubles. And at the time it was a 33 rubles to $1 US. And then all of a sudden in a matter of 2 months, it was 66 rubles to $1 US. So the value of my contract was cut in half. And so what the Russian government did is they bank rates went up to 15%. So I could put money in the bank and be earning 15%. But some banks were failing. So I was like, what am I going to do? So I ended up putting money in the government bank. It was called Spare Bank. It was run by the government and they were only giving 10% interest rates to keep it in a bank account. But still, can you imagine just keeping money in the bank, get 10%? Because they were so worried about people moving the money out of the currency going lower. And that's how they handle it. So that's how Japan should be handling this. It's just they're kind of caught between this rock and a hard place.
And it's the rest of the world. Everybody forgets, and not to repeat the episode because we talked. Jay, I forgot the episode number. Go back to that episode number. But remember, the rest of the world generally borrows in dollars, generally has dollars on their balance sheet. So when you're running a business in Japan or in Croatia or in Russia or in England, whatever, you've got to pay your rent in dollars. Right, because you borrowed or your debt in dollars, so you've got to pay back in dollars. And so when you earn your local currency, you've got to then translate that. You got to do the exchange to dollars. And if the dollar is getting 10% stronger, 20%, 50% stronger, like in Japan, your mortgage just doubled or tripled or whatever the number is. It puts a lot of strain on the system when the dollar strengthens versus another currency, as you're seeing in Japan.
If you want to read a really good book, there's a book called Global Shocks that really talks about currency wars and trade wars and the reality of how much of our interest rates, how much of the health of our economy, and what our governments do about monetary policy and fiscal policy really can come down to currency wars and trade wars, especially in a world, where we are seeing a lot of geopolitical shifting. We're seeing, the BRICS countries try to dethrone the U.S. as the world reserve currency. And right now, while we have the world reserve currency, we can handle inflation, we can handle debt more than, other countries can. But if we start to be dethroned and start to lose some of that status, and these countries that are trying to make that happen can have a lot of rapid success over the next 10 years or so, we could still end up with some currency wars and trade wars, which again will really impact the US Treasury rate more so than just what's happening here. So it's a really good book that talks a lot about Japan, actually, because it talks about how they were such a great economy. They were huge, booming assets everywhere. And then the debt got too big and they had a big debt cycle. And this is kind of a fallout from, the sins of the debt of the past. And so we have to be careful not to repeat the same thing.
Yeah, and I know we got to move on, but it just, again, illustrates the one part I missed on the whole sort of yen carry trade was that in order for any country to get those interest rates lower, they've got to print their currency, right? And so when the US prints their currency, because we have the world's reserve currency, because there's a huge demand for a currency, it's not a big deal. But when other countries, look at Venezuela not too long ago, Venezuela starts printing money, like, let's pay for all things from printing money. And then suddenly, crap, we have huge inflation because you're just printing currency and there's not enough demand. Same thing with the yen. I mean, the yen is the third or fourth largest currency, but there's not a tremendous amount of demand outside of Japan for the yen. And so they just can't get away with printing a bunch of yen to keep interest rates low, to keep buying all these bonds. And so the result is your currency starts devaluating. And like I said, in the last 4 years, it's gone down 50%, which is gigantic. So they're trying to fix that. But the only way to fix that is to increase interest rates, which creates all kinds of other problems, right? Anyway.
But Mauricio, you say it's not a big deal, but isn't that the exercise that we just went through? The US going down the modern monetary theory path of let's just print more, it won't cause inflation. Well, it did, right? So I think it's a bigger deal as our debt grows than maybe what you just said. But I mean, time will tell, right?
Well, so the question is the Fed taking into consideration like these global happenings, or are they still just sticking to their dual mandates? Like they keep talking about this dual mandate. And I think we had a good question from one of the listeners that came into Jay, where they're like, okay, the Fed talks about their dual mandate. What are they prioritizing right now? Are they prioritizing inflation? Are they prioritizing jobs? Are they looking at these other effects? So Jay, what do you think the Fed is prioritizing right now?
So, I mean, I'm just guessing. Obviously, nobody can read Powell's mind or anybody else's mind. But if I'm Jerome Powell and I'm looking at what's happened the past couple of years and I'm trying to get my head around the psyche of the average American, what I'm concerned about is inflation. Because we tend not to see prices go down. And so we need wages basically to catch up for several years just to get back to where we were a few years ago.
But it seems like the average person is the opposite, right? Like we've seen inflation stagnate. Like it's kind of been bouncing around at the same point. And yet when the jobs data is the one that comes in and we talk about the jobs, that's when everyone freaks out. So like yes, you might be worried about that more because you're looking more long term, but are the Fed going to pander to the masses more and with the jobs data?
I disagree. I think it's the investors that are looking at the jobs data. I think John Q. Public, who's going into his retail job or his construction job every day, isn't like getting up an extra hour early to wait for the July employment data to be released to see what the unemployment number is. But what he does know is that when he's going to the grocery store or he's going to buy dinner, that things are a whole lot more expensive. And so until he or she loses their job, which keep in mind, the unemployment number, 4.3, higher than it's been in a couple of years, but still historically very low. Most people have a job. Until they start losing their job, they're not worried about jobs, but they are worried about inflation. So my argument is that I think Main Street cares a lot more about inflation right now, and I think just all the flack that the Fed has taken and this administration has taken, and rightfully so, for not attacking inflation sooner and harder a couple years ago, I think that's sticking with Powell. And I think that if they have to choose between unemployment and inflation, they're going to choose price stability, and they're going to keep rates a little bit higher than they should for a little bit longer than they should, just to ensure that we don't see a resurgence of inflation. Not going to say they're not going to do anything, but I think they're going to be more conservative on price stability than they are on full employment.
Jay, have you tracked Trueflation? Oh, sorry. Have you tracked Trueflation? Trueflation is a website that's been tracking inflation since 2012 pretty well. It has like a 97% correlation to real headline CPI in real time. it's at 1.54% as of Monday. So it's showing not deflation, but disinflation, showing that inflation, at least as of today, in all the categories other than, the average is 1.5%. I mean, obviously the inflation that still is there is mostly insurance and some housing and healthcare, those, key sectors. But we are starting to really see inflation numbers, the inflation growth numbers come down substantially. So I tend to think they're going to shift gears to save the employment side and be pretty confident that the inflation numbers are coming down, at least in the short term, if employment ticks up higher in the next week or two.
I don't disagree with those numbers, and I know Kyle turned me on to University of Pennsylvania has good inflation data that I've been tracking for the last 6 or 12 months since he turned me on to that, which is saying very similar things. That right now inflation is actually much lower than what the government, or not much, but a little bit lower than what the government is projecting.
I'm looking at it right now, 1.97. Is the core PCE for the Penn State alternative inflation.
I'm sorry,
index.
not University of Pennsylvania, Penn State. Thank you. But again, I think it's these headline numbers, these economic reports. People don't care about that, and I just have to believe that the Fed is aware that people are struggling, and there's a perception that inflation is still high, even though it's not high. It's sticky. It's that prices that went up are still where they were. And even if they're not going up as fast, they're still high, prices are still high. And so I don't know. Again, I can't read anybody's mind, but if I had to guess, I think, and I could be wrong, but I think the Fed's going to err on the side of higher rates than lower.
You guys know, this is not a conspiracy. This is not the conspiracy episode, right? Is that next week? When are we doing the episode on conspiracy theories?
Let's do it next week.
But I know there's the argument. I was trying to find the actual numbers, but I don't know. But I mean, you mentioned something again. I just want to disagree with you, Jay, because that's what I enjoy doing, is trying to figure out anything I can do to disagree with
I'm
Jay.
usually wrong.
Is really cool. But you said something like unemployment's 4.3 and it's historically below average or whatever, however you said it. But the way we calculate unemployment has changed dramatically over the last 20, 30, 40 years. And I know Shadow Stat's one of them, but there's a bunch of stats out there that show if you calculated unemployment the way we historically calculated, it would be way higher than 4.3%. It would be, some people say it's over 10 or 15%. So you say, well, nobody cares about the 4.3. And I guarantee you, if unemployment rate came out next week and it was really 13%, people would freak out. And if you compare how we calculated unemployment back in the early 80s to how, if we just use that metric instead of how we've changed it over the years, you get a dramatically different, I don't know exact numbers, but I don't know. I just think when you say,
well, we've talked about it a lot, all these part-time jobs, gig work, all this stuff, all those people are considered employed, right? And they're, I'm talking to the guy on the Uber on the way home, and he does this part-time, and he reads manuscripts for a movie company a couple hours a week. And like, that guy's considered employed. Yeah. So it's like, is that a true indicator?
He counts as 3.
Well, and that's exactly the issue. The underemployment rate has gone up over 7% right now. And underemployed are those that are not fully employed, not full-time hours. And if you go back even as far back as to the end of the third quarter of 2023, when we said we created the 600,000 jobs, and it was actually negative 192,000 full-time jobs. So it was a 800 and something thousand people difference. Really, it's many people taking second and third jobs. And so we know from actual payroll data that always comes out and revises the history. We've only seen the revisions to that third quarter of 2023. They haven't even revised fourth quarter of 2023 or the first or second quarters of this year yet with real data. But the state level unemployment data and the state level payroll data that's coming through, it's showing that it's almost all part-time jobs, additional part-time jobs. We're already in negative full-time employment and haven't created any new full-time jobs that aren't healthcare or government in over a year. So I think when the real person realizes that, they kind of know it. They're living, like you said, check to check to check. They're working multiple jobs. They're like, why am I not okay? Like the Fed says I'm okay. I think employment is much, much worse than what the 4.3% reflects today.
It's the same as GDP, right? We say, oh, GDP is at 2% or whatever. But when you look at the deficits we have and you extract the deficit that we have, like, what is it, like a 2 trillion or $1.5 trillion? If you take that out of the GDP then we're at negative GDP. So it's like basically the borrowed money from the government that's going into the system is what's creating a 2% GDP. You take that out of the equation, now you're at negative. So when you start comparing, if you want to compare apples to apples, is all I'm saying.
Anna talked about the even just payrolls for healthcare and government. That's been propping up everything, right? We're in an election year. It's whenever we're going into election year, and the government spends money on, they hire jobs, they spend more money, and that's going to prop up everything, include jobs numbers, GDP, everything. So that's, that's a good segue into, we have an election coming up. Anna, I know you like to talk politics. You're not afraid to talk politics. Do you think this is going to have the timing of this? Because this was literally the Democrats were hoping that we could just kind of skate to the election, just kind of, maybe sneak in a mini rate cut, everything could keep going well, and that they would just historically, recessions have been the death knell for incumbents, right? Mm-hmm. And I guess we have Harris now. It's not technically an incumbent, but it kind of is incumbent light. Is this going to affect what's happening in this upcoming election now that we've kind of seen this little bit of fear that a recession is either here or coming?
Yeah, I'll start out with saying, before I'm accused of being a MAGA Trump doomer, I don't like either of our potential candidates, right or left. I don't think either is necessarily a great outcome. So who knows what's going to happen? But I will say this, in terms of historically, election years, the economy is hung on. And then right after the election is when the economy tends to falter. And so without sounding like a conspiracy theorist, but because I'm not, but the reality is most of those who sit on the NBER, who dates recessions, are Obama appointees. And so they can say that they're not political and don't have political bias, but all of us do, right? So if you just think I'm an Obama appointee and I'm on the left, and I don't want to blame Harris or Biden for the recession, they would love nothing more than to get past the election before they declare a recession. So I don't think the NBER would declare a recession before November, even if it's here and it's obvious and it's glaring, right? So, from that standpoint, they're not all apolitical because they're human beings and all of us have some sort of bias, right? The Fed does not want to be seen as political. So I think they would have liked to wait till November to say we have softening so that they couldn't be accused of throwing it either way. With that said, now that the economy has started to, people have had this freak out, the markets have had this freak out, they tend to be kind of self-perpetuating. So what happens in the next couple of weeks, especially if Iran goes after Iraq, I just think that's a bigger deal than what most people think. And we still see some of this yen carry trade unwind. I've read only about half of it is unwound, although I don't have evidence to back up the number. I think we can see more market kind of collapse. And if the Fed data this week is negative and we see higher unemployment, we start to see more intels, more companies go lay people off, or we start to see bankruptcies, I think that that's going to rock the psyche enough that it wouldn't bode well for the incumbent. It would be blamed on the Biden-Harris administration, and Trump will try to ride it to the election and say he's going to save us. Whether he can or not, I'm not going to opine upon. I don't think either one of them can save us. But I think that if things continue to go downward and materially change, I think that it's definitely more likely that you have a shift in administration than if we continue to float it until after the election.
I'm gonna take the opposite side and say that I think the rate cut that we are almost certain to see in September may do enough to boost the economy for the few months leading up to the election. I mean, given that it's 6 weeks before the election, it might be enough time for people to kind of forget this negative period between now and September if it happens. Not saying that's necessarily the case, but I do think it's quite possible that a rate cut could be enough to trigger kind of some irrational exuberance that kind of calms the national psyche and makes it a little bit gentler on the incumbents to not have to worry about facing a recession right now.
You guys have looked at this more than we haven't looked at. We talked about the emergency rate cut potential or whether that's going to happen. Have we talked about whether we think last episode, it was a 25 basis point. Any thoughts on whether it's going to be 50 basis point now or 75 basis point? We talked about that. What's the market saying?
Odds on favorites 50 right now.
Oh, so it's gone up. So it used to be 25 basis point. Now it's odds on favorite is 50 basis points.
I mean, we're at the point, like Jay, I think Jay's looking it up right now. We're at the point where like this thing changes by the hour.
As Jay looks at it, as I'm digesting the words coming out of Jay's mouth, which, I'm trying to figure out how do I counter his point. We all know there's a lag, right? There's no way a Fed official pulls a lever today that it has an effect before the election. It's going to have an effect 12, 18 months from now. Now, the perception of the effect is probably what, Jay, I assume that's what you're talking about. So if the Fed comes down and says, we're going to drop it by 50 basis point, and January next year, we're going to have 25 cuts next year. So that changes it, because obviously the actual cut it itself isn't going to help our friends in the multifamily business who need to refinance their loan and, in the next, 6 months. That doesn't help them. Right. So anyway.
Yeah. Well, and on his point before, like it's a bit of a self-fulfilling prophecy, right? Like if you tell people that we're not in a recession, they're going to spend like we're not in a recession. They're going to hire like we're not in a recession. But if you tell them we're in a recession, they're going to spend like we're in a recession, and they're going to stop hiring like we're in a recession. So like there is a bit of an immediate effect. It's just by the perception and what you're telling people.
But they're already starting to do that. They've already called Powell's bluff.
Let's do it. Can we do an over-under prediction on the cut?
Yeah. So for anybody that's not watching this, let me just call this out. So we're looking at basically the market pricing in rate cuts for September, and it looks like 28% chance of a quarter point cut right now, 72% chance of a half point cut, which is honestly down a lot from yesterday. Yesterday, there was an 85% chance of a half point cut. And I think that's a good indication, a good reminder that these are people that are subject to emotional roller coasters. Not that much has changed in the economy. Nothing has changed fundamentally in the economy between yesterday and today, but one good day in the stock market or one day that shows that the stock market isn't continuing to crash, and we're seeing a much lower chance of a half point cut in September. So I wouldn't put too much stock in this. A lot can change in the next 2 months, but I think the odds on favorite is that we're going to see a half point cut at this point.
So the question is, this is technically a real estate podcast, even though Jay likes to make it a political podcast. But so the question is this good for real estate investors? Like, is this what has just happened? Is this good news for us? And I'll start with Anna, because Anna's kind of does the same stuff that we do, and I'd like to hear what she's going to say.
Yes, it's good news for us. The faster rates are cut, the faster we have a technical recession, which I think we have and will have, I think will materialize. The faster we can refinance some debt that's high, we can have cheaper rate caps. So I think we've all been waiting for this. So I'm excited that we actually start, we're seeing some of it materialize and start to really come to fruition. So I think it's good news for those that are ready and prepared and can handle a recession. The negative side is when you have be careful what you wish for. When you have a recession, your NOI is going to be pushed, and cap rates don't just bounce back immediately. It's not like the Fed cuts rates go down, cap rates are going to come back down, and values are going to soar. Values are going to stagnate for a while. The good news is Class A and Class B multifamily cap rates tend to come down faster. Values tend to go back up faster than if you've got C class stuff or other asset classes. So all in all, I think it's good news that the economy is softening enough and quick enough that rates are going to be cut, and that I think next year will be a lot better for many of us that are currently holding assets and that want to buy properties at lower rates and lower values in the future.
The question is, how early did we catch it, right? Like I'm happy because we've figured, like the Fed seems to have figured it out before we had the wheels completely fall off, because that was going to be the issue, that the Fed was just going to wait, and then all of a sudden some catastrophic event that I think Mauricio and I made predictions about that I guess are maybe not coming true.
I predicted September, and that's probably what's going to happen.
Yeah,
September 2023.
Yeah, I think they're going to cut rates. I thought they would sooner, because I've seen deterioration of the job market for 9 months now, and 10, 11 months now. So I thought they would sooner. I think it's about
time. At least we haven't had like that catastrophic event that's going to be like blood in the streets for them to cut, that maybe we've dampened whatever recession is here, that they're going to curtail it a little bit, because the real estate survives mild recessions actually pretty well. Especially it depends on if it's real estate based, obviously, if people are going to be losing their houses and how banks are doing and whatnot. But if you look historically, especially that, as you said, maybe B class, even C class does pretty well. The really high stuff and the really low stuff gets hit. But so if we can stave off a bad recession, then commercial like apartments should do pretty well. But I guess my question is to Jay. A lot of people will be listening to this and wondering single family. So like we're the 10-year treasury just dropped. There's this rhetoric that people kind of talk about, that there's all these millennials and Gen Zs. They're just sitting on the sidelines waiting to buy houses, and that's why no one's buying and no one's selling, because of these high rates. Are we going to see an uptick in the single family homes, or are we? Is this we still waiting for another shoe to drop?
Yeah. So just real quick, just a graph to kind of illustrate the point that housing values are typically not impacted in a recession. This is back to 1965. If you go all the way back to 1900, basically what you see is the only major blip that we've seen in housing during a recession was during 2008. Now, if you look at the end of this graph, like the last couple of years, we're starting to see a dip in housing even without a recession, which is just an indication that we are so far above the long-term trend line that there's really no avoiding it falling back a little bit towards the trend line. The question is, will it crash back to the trend line, or will prices just kind of flatten out for a few years while the trend line kind of catches up? We don't know the answer to that, but as you mentioned, Kyle, it generally takes a recession that is caused by something fundamentally wrong with real estate or the lending market or MBS or something like that to impact housing in a major way. Doesn't look like this is going to be one of those recessions, but who knows? To your question about like where things are likely to head. This is kind of the framework that I use. We always talk about data. We talk about how important data is. We talk about how important the numbers are. But when it comes to things like the stock market and real estate values and other asset values, I kind of think in terms of not graphs of data, but this thing in my mind that I call a fear graph. And so imagine a graph and imagine a horizontal axis that is labeled 1 to 10. And that's the fear level. And on the left-hand side of the graph, you have fear of 1, 2, 3, like very little fear in the market, all the way up to the right-hand side of the graph, 8, 9, 10. And the question is, can you graph? And I think for anything, you can graph kind of what happens to various things based on fear. So for example, let's say we're going to graph like where I think the number of transactions we're going to see in the market are on this fear graph. So right now, for the last couple of years, we've been in really low fear. People haven't been fearful about market crashes or the economy crashing or anything like that. And so we're at like 1, 2, 3 on the fear scale. At 1, 2, 3 on the fear scale, sellers aren't selling. They've locked in low interest rates. They have low mortgages. They don't want to rent at ridiculous prices. They don't want to buy another house at a ridiculous price and a 7% mortgage. They're not going anywhere if they don't have to. So 1, 2, 3 of fear on that graph, we're going to see very little transaction. Now go all the way over to the other extreme, like the 8, 9, 10 on that graph of fear. Well, at 8, 9, 10, yeah, there's going to be a lot of incentive for sellers to sell. They're losing their jobs. They're terrified. They want to cash out the equity they have. They just want to get out of their house. But at 8, 9, 10 fear, for anybody that was investing back in 2008 knows, there are no buyers. When you're at maximum fear, lending is non-existent. Buyers are huddled in a corner in the fetal position. They don't want to buy. And so if you look at the right-hand side of the fear graph, there's no transactions. So if you were to graph transaction volume on that fear graph, what you would see is this kind of hump where you have very few transactions at 1, 2, 3 and 8, 9, 10, but you start to get a lot of transactions if fear goes to like 3, 4, 5, 6. Sellers start coming out of their shells. They're willing to sell. They're losing their jobs a little bit. Buyers are not too concerned. So they're thinking, okay, I got better rates, I'm willing to buy. And now suddenly transactions kind of go through the roof. And so you kind of can graph that fear, you can graph transactions on that fear graph. I would argue that you can graph pretty much anything on that fear graph. And one of the things you can graph is prices. And in my mind, on that fear graph, prices are relatively flat from like fear of 1 to like 7. Low fear, we're basically not going to see a prices move because there aren't going to be a lot of transactions. When you get up into the 4, 5, 6 fear, we're going to start to see more transactions. But there's enough demand out there right now that we're going to see all the sellers that need to sell, there's going to be demand to buy, and prices aren't going to move. It's if you get into that 7, 8, 9, 10 of fear, where sellers are desperate, buyers are only going to buy if there's a great deal. That's where I see prices dropping considerably. And so if anybody that didn't follow that, let me summarize. I think that the amount of fear we see in the market over the next year or two is going to determine what happens with prices. Assuming we don't see a 2008 type event where the fear in the market is 7, 8, 9, 10 on a scale of 1 to 10, I think prices are going to be relatively steady. If for some reason we see major softening or downturn, recession or depression, and we see fear of like 7, 8, 9, 10, then we start to see a big downward trend in real estate values. I think that's the unlikely case. So if I had to go on record, my guess is that real estate values are going to be flat through whatever we go through for the next couple of years.
What's fascinating about that is that was a great picture there. But like when it comes to single family, and I've talked a lot about this, but when you're locked in at a 3% mortgage rate as a single family member, you if you don't have to, you can't sell, because if you sell the house, you got to go buy another house, and that other house, even if it's the same value, the interest rate now is doubled or tripled or whatever you've had. So that makes no sense for you. So the only reason you would sell is if you had to sell because you got laid off. That to me is the only reason why people, if you have a 2-3% mortgage on a single family home, unless you wanted to splurge and you're doing really well and you're ready to upgrade it, the price to upgrade your house is tremendous right now if you've got a 2 or 3% mortgage. So the only reason you would move is if you had so much fear, you're at 9 or 10 because you got laid off. And you're like, I can't even afford this mortgage, even though it's 2 or 3%, I can't even afford it. So I have to sell, and I'm gonna have to go rent because I don't even know what I'm gonna do because I don't have a job. But that's the interesting dichotomy here. It's like this is, again, unprecedented, I think, from a historical standpoint. Like, when was the last time you had, Kyle, you've given the stat before, what percentage of people out there have a below 3% or 4% mortgage? It's a lot. So unless those guys get laid off, they ain't selling. But to my point is, in a recession, the odds of you having to sell because you got laid off, that number increases dramatically. If you have unemployment that gets to 10%, now you're forced to sell, and now you're going to see a flood of stuff on the market, not because they want to, because they have to.
It's something to just add to that, to what both of you are doing. I've kind of looked at recessions and supply and hyper supply of housing markets, and then the emotions that go along with that, to Jay's point. And usually you have hyper supply in real estate that then is associated very, very closely with the business cycle and recessions. And so you've got the recession hitting when there's also hyper supply. Well, now we don't have this hyper supply going into recession. It's like we skipped that section of the real estate cycle, despite the economic cycle still doing what it does. So when you've got a lack of supply, really from that lock-in to affect, Mauricio, to your point, if I do lose a job, unless I live in an area like I'm going to pick on Detroit and GM, right? All there is in that area is one employer or one industry, then yes, you have to move to find another job. But most, at least big cities today, have a pretty broad employment base, more job diversity, that I think your best option now, if you do lose a job, is stay where you are in your current house at your cheapest mortgage, because it's even going to be cheaper than renting in a lot of different scenarios. So I think it's just very, very different. I hate it's different this time, but in some scenarios, and in this one, I think it is different this time, because you've got my mortgage is 2.3%. I will never move. I don't care how, unless rates go back to zero and and there is a huge, rutting or gutting of the market and I can buy something nicer, even cheaper. I don't see that happening for the most part. I think people stay put this time, even when they're really afraid. And that, for most markets, we're undersupplied still, and you don't have a lot of choices of where to move. Now, markets that went crazy, like historically, Phoenix, Seattle, Austin, maybe they paid way too much. The value of their home's going down. Now they're willing to move if rates are, in the 4s or 5s instead of the 2s or 3s. But I just don't think it's going to play out the way that previous housing crashes have. And I don't think single family housing values are going to fall that much nationwide.
And I think it's the same reason for why I kind of threw something with Jay early on in the episode, which is you've never had a situation where the central banks interfered to the point where they dropped interest rates to zero. That creates consequences. And that one of those consequences were mortgage rates at like non-market approved levels. Like there's no way a private entity would lend you money for 30 years at 2%. They're guaranteed to lose money. The only reason you have that is because you had central planning interference. And so
we're like one of 3 countries that offers 30-year mortgages, and we're seeing the downside.
Yeah. So this is not natural. And so it didn't happen prior to 2008. I don't think you can go back in any point in history to see the Fed at 0% interest rate. Therefore, mortgages were at 2.8. What is yours, Anna? Did you say it's 2.3
on my primary? 2.3.
When was the last time in history that you could have gotten a 2.3% mortgage rate?
I'll never move. And I have vacation homes that are 2.5, 2.6%.
Well,
I'll never sell.
We talk about the upside all the time about the 30-year mortgage and how we're so lucky, but like we are kind of seeing the downside of it, right? Because you see apartment transactions still happen, because if you have a 2.3% mortgage rate, you could sell it and you can pass that on. They can assume that mortgage and the next person could take it. And we could kind of just pass all these mortgage rates along. And it does keep transactions.
The other thing you have today is you have several federal government programs incentivizing you to stay where you are and take equity from your home at a low interest rate without having to sell it. So I'm literally getting emails from my lenders with federally backed loans going, you don't have to have an appraisal and we'll give you a $40,000 loan because you have more equity in your house today. Well, if interest rates start to fall and I can tap into that program real quickly, I can get a loan. Why move? Just take the equity I need to sustain me until I find another job. So I think it is a little different this time. But like you said, Jay, I'm not real worried about the housing market reverting to its mean. If you go back to 1970, and I've done data on housing affordability all the way back to 70 every single year, even with blips up and down, historically, housing prices always still go up at least 1% a year. And that's with all economic conditions. And so I think over time, values continue to go up as long as wages keep up, unless we have some kind of major financial collapse of the United States. I think housing prices are just going to stagnate and maybe increase nationwide.
Yeah, and I know we got to move on, but real quick, because one thing we did not talk about, and I should have brought this up earlier on in the episode, and I didn't, but now that you talked about fear, this fits into it. We haven't talked about the VIX, right? Which is the economic financial instrument that measures fear. So when people get scared and their fear, they buy this volatility index. I don't know, Anna, you may know. I have no clue how this thing works. I don't know why.
Well, so actually, I would argue as real estate investors, you should pay more attention to the MOVE index, MOVE index, because the VIX is kind of more for people who are like in stocks and like the markets and stuff. But the MOVE index is really, that's what, like when we're talking about rate caps, interest rates, stuff like that, the MOVE index really, that's what we really care about as far as our loans and things like that. So
that measures the fear in the marketplace, in the real estate market. Is that what that measures?
It's volatility, right? So that's what. So like when we're talking about like, I think we'll probably talk about this in another episode, because as much as I love everything happened, we got a little bit screwed on a rate cap issue here. But when you're talking about pricing rate caps and future rates and SOFR curves and stuff like that, and how much banks are willing to lend, they take into consideration, okay, what is the forward curve showing as far as a SOFR curve? But then they also have to factor in volatility, right? Like how high are the swings up high and how low are the swings down low when they're pricing it? Because it's basically insurance. And that's why, like, if you look at when Jay was talking about before, the 10-year treasury and how typically how much above the 10-year treasury the mortgage rates are. Well, part of that is due to volatility, and like what banks are, they put a little bit of you would say a VIG on top of that, a spread, and the spread can be as low as 1.5, or we've seen actually a little bit lower than 1.5 historically sometimes. But I think, as Jay said before, I think historically it's like 1.75 is kind of the mean. But then we've seen it like in times of high volatility. If you not too long ago, a year or two ago, then it was like 2.5. So like that volatility index that you pay attention to, you can watch that index that you're saying. I'm as a real estate investor, I suggest watching the MOVE one over the VIX. Everyone talks about the VIX, but you can look at that and you can kind of see, okay, like what is going on. And if you go and look at the MOVE or the VIX right now, like over the last few days, it's
that's my point. Crazy. That's what I want. That was kind of what I wanted to was kind of point out, is that I just remember the VIX, especially back in 2008. I just remember the VIX spiking to like, what is it? It spiked to like 60%. I can't get that. It's like 60 points over here. And then it's been literally down at the bottom for like 13, like all this economic stuff we've been talking about, the jobs, it's been kind of stuck at the bottom. But if you look at 2008, it went up to like 60, then 2000 during COVID, it went up to like 60 again. And literally it jumped again this last week to 55. That's the first time I've seen in a long time where the VIX has really spiked. And that's another difference. Like it's like this narrative where like, oh, good news is bad news. Oh, it's bad news, but no problem because everything's going to be fine. But literally in the last 2 days, I've finally seen, I don't know what you're showing me, Kyle. You're showing me a screen of your phone that I've.
Sorry, I'm trying to show the MOVE index because
but I've literally seen something that the with all the crap that's been happening. Every time I look at the VIX, it's like still at 13, 14, 13, 12. Like nothing. Even though it looks like major things are happening, the VIX just stays at 12 at 13. The thing that's changed in the yesterday, I think it was that right? The fifth, yesterday on Monday, and it spiked to 60. Which is what I remember it during the financial crisis in 2008. It just spiked to 60 and stayed there for a while. Now it's come back down. We're back in the mid 20s. But I think that's another difference between what's happened in the last couple of days from what's happened over the last couple of years. We've gotten bad news, but now the volatility index has skyrocketed. So that's something to point out.
As you said before, bad news is back to being bad news, which I guess to me, that's just good for real estate investing, right? Like we can get transactions done no matter what, as long as we know what the rules are. And it's just this uncertainty and not knowing what banks are going to do, not knowing what the rates you're going to get are, not knowing what the Fed's going to do, all of these things that just breeds like people just sitting on their hands, not doing anything. So hopefully this opens things up. And
hey, are we going to do a 2-hour podcast today? Is that the plan?
Oh, coming from the guy who like we had this, I was about to wrap this up and then you just add a whole VIX and MOVE index into the conversation. So
hey, I
then criticize the moderator after. I thought I moderated this pretty well, actually.
Dude, I've seen some YouTube videos like Lex Friedman. They'll do like an 8-hour podcast. We should do an 8-hour podcast.
We need a lot more than coffee for that.
Or a lot more alcohol.
We're gonna need more than coffee and alcohol, I think, for that. I don't know if I've ever had alcohol get me through that. All right, let's wrap this up. Anything else? Anyone want to say anything other than yay for real estate?
Yay for real estate. I can tell you this: real estate in the bottom. If we do hit bottom, it's the time to make the most money you've ever made. So I'm excited about what's to come. The bottom line, wrap it all up, is things are softening. That's going to be a maximum point of opportunity for us. We've been at a high volatility, maximum point of risk waiting. And I think we finally have a point where, bad news is good news for us because rates will come down. We can buy. There's always going to be a motivated seller. So, I think the biggest thing is buy for the long term and hold on until we have another expansion, which will come at the other end of this.
But for any renters out there who are listening, everything's fine. Just keep paying your rent every month. It's all going to be okay. All right. Mauricio, you want to do a top 10?
I do not want to do a top 10, but that doesn't matter. You're going to do a top 10 anyway.
Damn right I'm going to do it anyway. And I don't know about you guys and gals, but I have been watching a crap ton of Olympics. I love it. It's on in the background all the time whenever I'm working. It's kind of like prime time Olympics is right during the workday. So it's always on there. And you just get so much so much joy out of random stuff, like the Turkish guy with his gun, and like the American hurdler, the girl who did the semifinals, and she won by like 20 meters. It was crazy. There's so many random things, and I love it. And they put on such a good show that I started thinking about how much must all of this cost. And so I went back and I looked, how much do the Olympics cost? And you knew it was going to be staggering, but just the glow up that has been absolutely staggering. And what people will say, oh, the IOC, pays for the IOC pays for very little of it. I looked that up too. And the IOC only puts in about like $1 billion. And the rest of it comes from, they have to generate from TV revenue from the city. And anyway, and we have LA coming up as the next Olympics. Mm-hmm. So I was like, oh, is this going to be a good thing for real estate? Is this going to be like, how much money they're going to spend? Is it going to offset it? So anyway, I'm going to go through the top 10 Olympics by cost to put on them. And I'll do it real quick, Mauricio. Don't worry. I know
can I spend 20 minutes on this topic right now real quick?
If you want, if you're that into it.
I literally saw this, like nobody wants to do the Olympics anymore. Like the reason LA has the Olympics is because they had to give it to the LA and Paris at the same time because they were worried that nobody would want to bid because the costs had gotten so crazy that nobody wants to house it. And what happened, I guess, was in '84. Anyway, it's a long story about that, but like it's just like nobody wants to do it because the cost has gone so high. So I won't get into it. But
I'll go through it real quick. So number 10, you go back to 2000 Sydney, that cost $5 billion, which sounds staggering on its own, but that was back in 2000. And this is all indexed. Because obviously we go back to 1976 Montreal for number 9, and that's 6.1 billion. 1980 Moscow, 6.3. 2008 Beijing, that was 6.8. 1992 Barcelona, that was 9.4. 2024 Paris was actually only number 5 on the list at 9.7 billion. So we're already doubling from the 10th place. 2016 Rio was 13.7. 2012 London Olympics was 15 billion. The 2020 Tokyo, it's always Obama's fault. The 2020 Tokyo Olympics, that was 20 billion. And first place was the 2014 Sochi Olympics, $21.9 billion. So there you go, Mauricio. I don't know how, I know they get TV deals and they get, tourism exposure and all that stuff, but I don't know how that's adding up to 20. The city that puts it on. Anyway, it costs a lot. So who knows what LA, because LA is going to want to do it up great. And I'm watching these Paris Olympics, it's crazy. They put like beach volleyball courts at the foot of the Eiffel Tower. Like the setup's awesome. And there's so many cool things in Paris. I don't know why LA's got what, the Hollywood sign? Like,
how are they going to pay for it when they have so many people moving from LA to Texas?
It's true.
The cool thing about cities like LA is that they don't have to build new stadiums. They've got so much infrastructure already. They don't have to spend as much building new stadiums. If you go to a smaller, like a third world country, South America, which one some of the issues, you got to spend so much money just building.
Yeah, Sochi, they had to build everything.
Yeah, and then they don't use them. So then you're done with the Olympics, and then they just
rot. So actually, fun little story about that. Sochi, they built a hockey rink, and so they end up getting a hockey team just because they're like, oh, we have everything here. We have the rink, we have the infrastructure, everything's here. So they end up getting a hockey rink in the Russian league.
Wait! I thought we were talking the Olympics. I didn't realize we were talking about the Winter Olympics. Is that really the same thing? The Winter Olympics are not the Olympics.
Oh, jeez, we're gonna have to get into that. All right, let's just move it along. Real quick, I thought I'd do a fun little thing. Another piece of news we're not really going to discuss much, I don't think, but I thought I'd just throw it in. Kamala Harris just announced her VP pick today. It was not my Pennsylvania boy. It was the guy from Minnesota. So it doesn't seem to matter who these presidential candidates pick as VP picks. No one really seems to like them. Everyone always says why it wasn't a good pick. So my question was, if you were a president or running for president, who would you pick as your VP pick? And I'll start with Anna because I think she's going to have a great. And don't give me the arms up, Mauricio. This was in the doc. If you read the doc, you would know this was a question that was coming.
This is the dumbest question I've ever heard. But anyway, go ahead. I know that Anna to have to answer this question, but go ahead.
She's going to be prepared. She's got something ready. Watch.
I'm saying this not just to flatter you, Jay, but I would definitely pick you as my VP because we would get along. We could put our financial heads together and we would try to fix this screwed up financial system.
But you would lose is the problem. Yes, you. No one
I
knows
wouldn't.
Jay.
Who are we kidding? You guys are kidding yourselves. Keep going.
No,
Jay, who would you pick?
I would.
I would just say
You
I
better
would pick
me
Anna
too.
because clearly she's the best choice. But here's the thing. I mean, if you're supposed to pick somebody that everybody hates, as you said, Kyle, then I would pick you. But you're Canadian, so you can't. You're not qualified. Mauricio, you were born in
I'm not even eligible. I came to the States on a boat. I'm a third world immigrant. Like I don't belong here.
like the fact that you two can vote in this election really bothers me.
Tell me who you're voting for, Jay, and I'll
thought-
just vote for the opposite.
That's true. Or neither of us need to
Are
vote.
you asking us like who we would vote? Like if we were running for, we had the nomination, what person we would?
Yes, and it could be anybody. Like my pick's Bradley Cooper. I think he's a great pick. He's a Philly guy. He has shown great character. He's very good looking, obviously.
Y'all kind of look alike a little bit.
Well, that's why he's very good looking. And he's a huge Eagles fan. And when interviewed and he was asked if he had to choose between winning an Oscar or the Eagles winning the Super Bowl, he picked the Eagles Super Bowl. So he's obviously has excellent judgment. And so I think he'd be a great pick for my VP.
Clearly he doesn't have excellent judgment if he agrees to be your VP pick.
Oh, anyone would be my VP pick, Jay.
I would pick, and Anna is definitely, of all the people we've ever had on this podcast, Anna is my pick. But if I really wanted to win, I need a big name behind me. So I'm going Mark Cuban.
It's a good pick. I like that one. See, that's a well thought pick. He would, I don't know. He might probably try to figure out how to usurp you and become the president. But
I'd let him.
Mauricio, you got an answer? You're just going to be grumpy over there.
Well, originally I thought like, who would you pick? And I'm like, well, I would pick the same person everybody else picks in real life, which is whoever's going to make me win the freaking election. That's the only reason these people get picked is because they can help him in whatever state that's a swing state that can give him an extra point so I can win all the delegates and I can win the thing.
Well, given the two VP picks, I don't think that's the case.
It's got nothing to do about who's the best qualified, who agrees with you, or who would be the best president if I died. Like, none
Mauricio,
of that
I think that precedent died back when Sarah Palin was picked. They thought they were doing that, and it did not work out very well.
She was getting the Alaska vote.
If that's not the pick, I would just pick a VP that I want to spend. Who's the one person I'd want to spend all my time with? Because I'm not going to win. So who am I going to hang out with for the next 3 or 4 months? So, and I don't know Tony Robbins or something. I don't know. I'd like to hang out with Tony Robbins for 3 months.
He'd be a good pick. He's a popular guy. He would get you a lot of votes.
Yeah, I'll go with Tony. We'll hang out for 3 months. I'll get to know him. We'll be best buds, and I'll learn a lot. Otherwise, if I really think I'm going to win, then I'm going to pick whoever's going to do that swing state. If it's a Pennsylvania guy, a Michigan guy, whatever the swing states are, I'm picking whoever's going to turn that for me.
Jay, you would be an awful pick because you love to argue. And that's the last thing that a president wants is a vice president who's just going to argue with them all the time. So you would be an
argues in
awful
a
pick
nice
as
way,
well.
though.
Why would you pick somebody who's always
politician.
wrong? That's the part I don't understand. Why would you pick somebody who's 100% wrong to be your VP? That makes no sense to me.
Well, we should pick you then, Mauricio. You're 100% right.
That's right. I should be everybody's
Okay,
VP.
let's move it along.
Oh, okay. Now Jay's getting. Let's move it along. Let's put a timer on Jay's talk this time. Actually, Anna was up there too. Anna, you held your own. You got a little more comfortable last time. You were a little shyer this time. You were up there with Jay.
She crushed it, man. She crushed it. Thank you, Anna. Appreciate you being here. Way better than AJ.
We will give you the first plug then because you did so well. What do you got to plug for us?
You know, I really don't have anything huge to plug other than I have a book coming out. So watch for that in September. If you are looking for coaching, real estate coaching and consulting advice, you can find me at AnnaKellyInvesting.com. You can follow me on social media at Anna Kelly REI Mom.
Ooh, okay. All right. I think I follow you, don't I?
You better.
Have you posted in a while?
Yes, constantly. I thought you stole your show ideas from my Facebook posts. Knock me down a little. No, just teasing.
Well, I'm not on Facebook. So, Jay, what do you got?
I'm not going to plug anything. I'm going to go back and I'm going to fulfill the promise we made at the beginning of this episode to give away a mug to somebody.
Wow, that was so long ago. I kind of forgot about that.
I know. But this is what I'm going to do. You have until Thursday night. So Thursday at, let's call it midnight.
Wait. Before you give it away, they better involve a like, a comment, and a subscribe. I just want to say that.
Absolutely. So start by like and subscribe in whatever platform you listen to. But go to YouTube, leave a comment where you think the S&P 500 is going to close next Tuesday afternoon. So basically, you have by Thursday at midnight to tell me what's going to happen with the S&P Friday, Monday, Tuesday, closing Tuesday afternoon. Whoever gets it closest. We're at 5240 right now, 5,240. Whoever gets it closest will get a Drunk Real Estate mug. I might even throw your name on the mug. It might even be a customized mug.
Ooh.
For Drunk.
Can I play? Well, I want a second one so I can have a beer with a friend.
Okay, then you guys can play.
All right, Mauricio, let's wrap it up. What do you got?
I am going to plug Real Estate Syndicate Live. I've got Jay Scott, the one and only Jay Scott, on the show next Tuesday.
Tuesdays now.
I know it's Tuesdays at 11:30 Pacific, not Mondays. But the Tuesday next week is Jay. We're going to do an economic update, but you get to ask him questions one-on-one. So if you have a question for Jay, right, because it's live. So if you come on the show, you get to ask him a specific question. He's going to answer it on the show. So realestatesyndicatelive.com, register for Tuesday, 11:30 a.m. Pacific. Jay Scott, every year we bring him back twice a year for a macro update, and we're going to do that on Tuesday of next week.
And anybody that can stump me on a question gets a free 5 hours of legal consulting from Mauricio.
That's going to cost me like 600 hours. Man.
I'm not going to answer a single question.
All right. Always.
But I am going to do this. Come join us on Syndicator Live. And we will be giving away another Drunk Real Estate mug.
How many mugs you got? Why did I only get one?
China. I get as many as I want.
I want a whole set. I want like friends to come over and we all like clash mugs.
We need a control supply, Jay. We can't just be giving away mugs like they're like commodities.
Yeah, you should engrave them with numbers. This is like mug number 2, mug number 3.
One of 7.
Yeah, exactly. All right. As always, I'm going to plug my wife, Badass Investor, at Badass Investor on Instagram, Badass Investor on YouTube. Go check her out. You like that? This is a random thing that I found on my dad's desk. Look at this thing.
You have to go on YouTube if you want to know what he's talking about.
Just here. Oh, look at it, you kid. All right. That was a great episode. Anna, thanks for coming out. We're always great to have you.
Thank you.
Thank y'all for having me. It's been great.
Well, since Jay's giving out mugs, I think you deserve one too.
I'd love one.
There we go. I had a pretty big beer, so this kind of lasted me the whole thing. So my drink is almost gone. I got to go hit the head. Hopefully AJ will be back. If not, maybe Anna's permanent replacement. Otherwise, everyone else, I will see you next Tuesday.